nothing, man. I just think this year will be very exciting, and just hang on tight lah. The collapse might be here.
Yeah. All right, guys, welcome back to the channel. Today, we have invited our friend, Mr. Sean Fu, to the shows. So, for those who don't know Sean Fu, he's one of the biggest YouTuber in Singapore, covering financial news and also all the macro stuff. So, I think in the panel here, he's the one that have larger subscriber counts compared to Kelvin, right? Wait, is that right, Kelvin?
Yeah,
Have you updated?
my days are numbered.
Yeah, so we are thrilled to have here, Sean.
Thank you for having me.
So inviting you, we have to ask market questions, right? So, and if we look at the market over the past week, right, it seems that US market already crashed.
Right.
So especially all the names related to tech. So Sean, you are covering a lot of all these macro news, talking about US in general. I don't know whether you focus on tech stocks specifically, but just want to get your take on the current environment. What do you see now? What are you observing?
I think what we have now is mainly a big valuation issue, right? It's not that the US market or tech companies are all going to crash to zero. It's that how much money is really going to the system, how much money is being wasted, and all these valuations, which I personally feel, right, is quite bubblish, right, quite frothy, right? Is it really justified or not? Like over the last few days, I think it was 3 or 5 days ago, DeepSeek came out, right? And that just threw a wrench into the entire system because it showed that you don't need to brute force your way all the way with the highest hardware. You don't need to spend millions and billions of dollars. There's always a certain software workaround it, right? It makes the solution a bit more elegant so that companies can actually spend less. So if you look at all the companies, all the tech companies, right, the biggest fall was in fact Nvidia. I think it's like 15 to 20% down today. And it's because tech companies in the US around the world, they just thinking to themselves, do I need so many chips or not? Do I need to buy so many chips to run to develop my AI models, to develop my AI solutions? Or can I just use DeepSeek model or use a more of a software workaround? And it's quite interesting if you look at all the different tech companies, like Apple actually went up. And it went up because they were lagging behind the AI race. So investors, you're like, okay, at least Apple didn't burn so much money. So, okay, I think it's good to invest in them now because valuation is still at reasonable compared to the rest of the Magnificent Seven. So we have this kind of very weird market, how do I say, segmentation.
Yeah, so Sean, on this DeepSeek episode, right, there are basically like two camps, right?
Yeah.
One camp is saying that, oh, you see, now we have such an efficient model, we only need some, like second tier, third tier hardware to run all the LLM training and inference, right?
Right.
And then on the other camp, which I can say I'm on that, the other camp now, which is saying that, wow, all these models are so efficient, there will be many more people who will be using AI. So it will actually increase the aggregate demands, right? And this is really bullish for Nvidia. So between these two camps, where are you sitting? Are you?
Okay, I am cautiously bullish Nvidia, 60 to 70%. And here's why, right? I think you're right that because when everyone use the DeepSeek or create their own model or China create something tomorrow, right? Everyone will move more towards AI, then everyone will be using enough low-end chips that everyone will all be on the same competition level. Then you have to move up to more high-end chips, right? But the problem is that how long is this gap going to be? How long is this adoption gap going to be? Is it going to be 1 year, 2 year, 3 years? Because if it's long enough, right, you could have local domestic US competitors coming out with their own chips, or next week China is going to come out with their own chip again, right? We don't know. So the thing is, how long can Nvidia, how do I say, keep the story going up? How can they keep the pump up? That's my big concern. For tech, right, I think the biggest winners are going to be the integrators, people like Microsoft, which is funny lah. They own OpenAI, right? But Microsoft and Facebook, maybe YouTube, Google, they can all use the AI to boost their algorithms, boost their services lah. So I think this will be the immediate winners. But for Nvidia, I think it's a coin flip. If you got diamond hands, you should be fine. But I think the shakeout can be quite worrying lah over the next few months.
Actually, Boon Tee, are you worried? Like you own, I don't know how much you own. You own a lot of Nvidia. Like I see the fair value is almost half of its current valuation. Are you worried of this thing?
Uh, okay, before this DeepSeek came out, right, I was worried about whether the demand will keep up or will continue to grow at current pace. So I know that because now they just started, right? Let's say like started since last year, this year continue, no problem for 2 years. But once we talk about like 2026, 2027, like all these, hyperscalers, they won't continue to buy at such big scale, right? At a certain point, they will say that, oh, I actually have enough. So I do see this slowdown coming, just don't know when. So I was worried on that slowdown. But specifically on DeepSeek, whether I'm worried or not, the answer is definitely no, because people are just worried because you come up with one model that is so efficient. But if you track the AI progress over the past few years, right, all this improvement in terms of efficiency, right, from model to model, from different generation to newer generations, a lot of software optimizations, these are all not like, just flare suddenly one DeepSeek jump, right? It's not like that. It's really like progressively every year you will see improvement in all sorts of different places and all add up to the efficiency. So DeepSeek, I would say, it's just one small blip upward, and then this improvement in terms of efficiency will still continue. So I don't think this DeepSeek is the one that we should worry about. But generally talking about overall demand, yes, that slowdown will come one day. I'm not like saying that Nvidia can only go up to the moon in terms of their sales. Yeah.
Okay.
I have one question for like content creators, basically all of you lah. Like
Yeah.
because I create content, but I'm not a YouTube per se lah. So I just want to check. Like I just saw a clip right from Alex Hormozy. He was saying that what this AI will do right is it will flood the content market. Like basically you can just take AI and generate a lot of videos and content, and then like just one day post videos. I can take the most popular like YouTube videos and the most popular Instagram video of all time, because they have all the data, right? Then they just assimilate and then just churn out 1,000 like different videos with all the features that you guys have.
Right.
Like maybe Sean have like those very powerful thumbnail. You will just aggregate all of them, learn about how you do your thumbnails, and then churn out like 5,000 thumbnails. Then I just start up a YouTube channel. Then I mark it as AI generated, whatever. Nobody cares, right? But people look at the thumbnail, wow, this looks like the one I always click on. And then if they flood the market like this, right, then it becomes like, how should I put it? It becomes like a bit, the consumers, we won't know how to like really pick and choose like those human generated one only. And it's just like super flooded. Like Kelvin's video, I can like generate 10,000 shots and put it out in a week. And then Kelvin's own video cannot be found. Like I can't even find it on YouTube. Then what happens? Then like it's YouTube becomes like AI.
I think is in the initial phases, right, which might even last for years, right? I think there'll be some attrition, there'll be some market share, there'll be some views, there'll be leech away. But at the end of the day, right, if one person does that, there'll be a flood of other content creators around the world also doing that. So the whole market there will be saturated as well. So I think for content creators, right, like me, like Kelvin, I think the challenge, right, is how to build a real connection with your audience. That's one. Then you need to find other ways to monetize beyond just AdSense. I think that's two. And just diamond hands your way through it, lah. And that's three, because I don't think YouTube is that stupid to allow this flood of AI bots to continue forever, right? Because they are still an advertising model. And if advertisers, how do I say, they see these kind of things and then the viewership of YouTube slowly drops over time, right? Then Google, the parent company, will be in trouble, ma. Then you have to clamp it down sooner or later, lah. But as we know, lah, these companies are very slow moving, law. So there might be some tough times coming for me. I don't know, maybe the next few years.
For me, I also not that worried lah, because like Sean mentioned, that's the I think the biggest thing for influencers is the relatability lah. So when a lot of people come to me, they say, oh, I want to make like PowerPoint presentation for my channel. I don't want to show my face. Then I tell them it's never going to work, because people aren't going to relate to you. They can't even see your face. How can they even relate to you? So, but maybe Lisa is different lah. Lisa adulting, or she has a sweet voice. Maybe people relate to.
She show her face already.
Yeah, but before that, she did quite well because people relate to her voice. And maybe the secret is to have a good voice for AI. But I think for most people it wouldn't work because even she is sharing her own personal experience. But if you have AI, okay, you can create fake scenarios, but I don't know how well will they work. Well, will that work? Then when you mention about the creating shots of me, maybe me lah, flooding the shots thing. I think Mr. Beast he also said this before. He say a lot of people use his shots to they clip his shots, then they go and put it up. But that's a good thing for him because they are advertising for him. So people who don't know about Mr. Beast, they saw his shot. Oh, then say, I want to watch more. Then they go and search for his channel. So all this theft, I don't know, all this stealing AI thing is actually helping the Mr. Beast lah. So if you want to make for free shots from me, go ahead. That's free advertising. But I think AI actually it does harm a bit of the search. So like let's say if I want to search for the next Spider-Man movie, right? You search on Google, the first thing they'll show you is some fake trailer thing, then some fake interview. It's sort of like a lot of clickbait stuff. Then you have to dig very deep to find the real answer, like when is the next movie coming out, this kind of thing. So nowadays when I search for stuff, right, my first place would be to go for Reddit. It has a lot less clickbait stuff. Then anything I will go from Reddit, then go to Google search. Yeah.
Okay. I think we need to come back to financial questions again. So Sean, just now you mentioned that you look at US market, not talking about tech specifically. If you just look at overall market, it's overvalued. And then we all know that, let's say compared to just a few years ago, right, when the market valuations was much higher, but the bond yield is a lot lower, right? So you got really no alternative. You have to buy US stocks. But right now, if you look at bond market, the yield is quite, decent. So you can get close to 5% if you just invest in bond, right? Why should you take so much risk to eke out that additional few percentage gain, right? So what do you see like in terms of different asset classes? Do you think that bond market or bond instruments give a good alternative?
Well, I think it's very complex, right? Because I think back in 2023, right, yields were already quite high, and the US stock market kept going up for a variety of reasons, right? And I was still invested in the US market. That's why I caught the wave up, even though I had some money in like money market funds, lah. So I think the best way is to always be invested in some risk assets, like equities, because you just don't know what's going to happen, right? And if we look at what really drove the US market, in my opinion, right, was a lot of government spending, and the narrative of US being exceptional is still there. So a lot of money from the world, they just rush into the US market now. And going forward in the next few years, right? Like for example, Trump is a wild card. His tariffs could work, it might not work. And okay, and even if it doesn't work, right, his response to it, right, could be to flood the entire US economy with a ton of stimulus, and that will create a rising tide that rises everything up. So in this case, right, sometimes people who just close their eyes, they just dollar average in over a long period of time, they will be the winners.
Why is Kelvin laughing?
Actually, John, you are holding gold, right, to hedge against something else? Like why
Uh,
are you holding gold?
Okay, so gold to me, right, is one of the benchmark assets, right? Okay, so for me, right, when it comes to investing, I always have three benchmarks in my mind, right? So it's like long-term assets I'll hold. In my opinion, is a risk-free long-term, right? We all know the risk-free rate is like, for example, US treasuries, right? Government bonds. Those are so-called risk-free because they can just print the money, right? But over a long period of time, you know that inflation is going to stay high, and certain benchmarks are quite proven over time. So the first one is like the world index, right? BT or WBRA. That one returns you between 7 to 10% a year since inception. Then S&P is like 8 to 12% for the long period. Gold is like 8 to 10% or so for the long period, for over 50 years. So I hold it as one of my allocations. And going forward, right, I think there's going to be a bit more demand for gold, which could possibly allow it to outperform US stocks as well. Like we have seen it last year. US stocks went up around, I think, 26 to 29%, around 28%, right? But gold appreciated by 30 to 32% at that period of time, even though money was going to the US market, right? Even though bond yields were very high, right? Gold was actually going up because there's a lot of uncertainty in the world, geopolitical uncertainty, and governments they just kept printing a lot of money.
So how do we compare gold versus the hot asset class right now, which is Bitcoin? I think when we talk about future,
Right,
no 2025 outlook, right? I think Kelvin is the one that's super bullish on Bitcoin.
right,
So
right.
Sean, your gold versus Kelvin's Bitcoin, which one is better?
Okay, this one this one's very hard, because intrinsically, right, gold and Bitcoin, you can argue both has no intrinsic value, right? I mean, okay, like gold, you can wear it as what they call it jewelry, but other objects are also shiny, platinum, silver. Bitcoin, you Bitcoin, you can say, it's seamless, you can transport money all the way around, but it's so-called in the ether, right? And then people can say if there's some kind of like EMP attack, right? There goes your Bitcoin, for example. So I think a better way to look at it, right, is how do you see them as reserve assets, lah? Like countries, where do you see the big countries, the central banks putting their money into, right? So I think the good thing about both, right, is that it is independent assets, right? No country really has a hold on them at all, right? Like for example, US Treasuries is an asset, but there's a big liability if you're a country that they don't like, right? They can just seize it away, for example. But Bitcoin, you can't do that, right? It's throughout the entire chain. It's an open ledger. Gold, you also can't do that because every country in the world, they have huge amounts of gold. So I think the question is like, which do you think is more long lasting, and which do you think will how do I say, which asset do you think governments will invest more into? So for me, my case is more gold than Bitcoin. I think Kelvin is a little different, more Bitcoin than gold. And yeah, I think it's really the argument.
Okay. No lah. For me, gold. For me, Bitcoin and probably also gold. Is just a hedge
Right.
against. It's basically for me. It's as insurance lah. It's not a get rich kind of thing.
Yep.
Yeah. If it's to get rich, I will have whole more Bitcoin plus gold already. It's not like probably the allocation is like less than 10% into crypto.
Mm.
So yeah, but I do see gold. I mean, I do see Bitcoin going more into like the reserve country's reserve lah. I think for US they have that whole debt problem, right? So I saw this theory where they say, oh, we want to hold Bitcoin, and because Bitcoin can appreciate a lot faster than US dollar, it can help to eat away our debt,
Right,
sort of
right.
clear our debt.
Yeah, that's true. But I think there's also another narrative that we might need to keep in mind, right? So there's one advantage that gold has over Bitcoin, and that is gold is totally opaque. Technically, you do not know how much reserves a country has. This is what they tell you only, right? Like the gold in US, the gold in China, no one knows the true amount. However, when it comes to Bitcoin, right, it's an open ledger. For example, anyone, if you try hard enough, you can find the keys of the US government or whatever government, how much Bitcoin they own, right? And that makes it a bit susceptible, right? If let's say, for example, the US decides to punish XYZ country, they decide to sanction them, say that you cannot trade with China, for example, and XYZ country decides to trade with China using Bitcoin. So that is a vulnerability. They can trace it and then they sanction you. However, if you use other another reserve asset, for example, gold, the whole thing's totally opaque. No one knows until you declare it. So that's why I think to me it's really 50-50 lah, because Bitcoin has a lot of advantages. You can just put it into your wallet, you can fly halfway around the world, and then your money is there. So consumer demand is there. But for central bank demand, right, I think they also will be quite afraid of putting too much into Bitcoin.
I have a question. Just now you were saying like what Bitcoin can be traced and all that. I
Yeah.
thought the main advantage is that you can be anonymous, like they were saying lah, through Bitcoin, because you can't really trace like whose account is it, and unless you made it public.
The thing is that a lot of okay, I think you all heard of this person called CoffeeZilla before, right? There's a reason why he managed to go after all, for example, the YouTube crypto scammers, right? People who release their own coin, is because at the end of the day, right, if you have enough investigative powers, right, you can track individual wallets, right? If you go down the chain long enough, you can actually track who buys what, who sells what, and if you see individual wallet, right, own like $30 billion worth of Bitcoin, you know that it's either a whale or it's a government or something, then a lot of questions gets to ask. But the only way you can get into a gold reserve is to physically break in there, right? So there's a bit of a difference here.
Actually, there's a way to sort of hide your tracks lah. So there's this app called, I think called Tornado Money or something like that lah. Was it Tornado Money? Yeah. So like one way to obfuscate your tracks is to, I know the hackers do sort of steal the money, send the money into this tornado track. Then because it get mixed up, then the money sends out probably to a different wallet. So like there's no way to know, like let's say you have $1 billion worth of Bitcoin, you can send it to a lot of different wallets, but you one person own all that wallet. So you can actually hide your tracks if you really want to. Yeah. But
Okay,
it's
but
still
actually,
a super new technology lah. Yeah.
so the big question is actually how much should you like hedge your portfolio using gold or using Bitcoin? Because I think I remembered like Calvin, Boon Tee, myself, we have initially I think we have around like what 2 to 5%, or maybe closer to 10 after it went up quite a bit. So yeah, Sean, you only hold gold to kind of for the portfolio
Uh,
allocation wise, right?
okay, so my allocation is I have crypto, but it's less than 2%, right?
Less.
Then I have 20% China stocks, right?
Mm.
Then around 30% US stocks, and the remaining 28 to 30% is the world index, which I separated out lah. So that's more or less my allocation going forward lah.
So you rebalance it like quarterly or
I rebalance it quarterly, like so sometimes I do take gambles, and for example, I think there was one time I bet a little more into gold miners, then the thing went up by 40% over a year. Then I just sold everything, and then I just take the money, then I just throw it into the world index lah. So from time to time, I do take speculative bets, and if it goes above my certain allocation, I just trim it down and I put it into the underperforming asset lor. So let's say S&P fly up 50% this year, then gold only goes up 5%. Then I will cash up some of my S&P and I put into gold lah. Then vice versa lor. Just keep things within the allocation lah.
So, Sean, do you want to talk about this concept? Like we are talking about understanding compensated risk, right? So some investment is like, okay, it's risky, but you are actually being compensated, and then
Right.
some actually not compensated. So I know you did some research on this. You have a view on this, right? You want to share with the audience?
Yeah, I think it's very important when how we allocate our money, we must do it smart, lah, right? Just because you're taking a risk, right, doesn't make it a good risk. Right. So for example, we talked about the various benchmarks earlier on, right? About gold, world index, S&P. So we can all say that more or less they average 9% a year, right? So this should be your benchmark. This should be your benchmark rate, 9% a year. So whatever investment you make, right, long term, are you sure that it's going to go above 9%? If it crashes, fine. But if it actually skyrockets to the moon, is it a compensated risk? So for example, right, I think Boon Tee is a great example of someone who won from compensated risk, right? Like you put a lot of money into Nvidia or some money into Nvidia, and when the thing shot up, how do I say? How many times did it go up? For you, 4 times, 5 times?
Nine times,
Nine times, right?
yeah.
9 times. So that's a compensated risk, because on the flip side, if you lost the bet, right? If Nvidia did nothing, you'll be losing 9% a year at the very least, right? Or it could actually go down. So when you do your compensated risk bet, right, you need to make sure that there's enough upside for you, and you really do your homework very well for individual stocks that the upside is going to be there.
So are you saying that compensated means that the potential is big? Or there's this quote saying that it's not about whether you are right or wrong, but how much you make when you are right and how much you lose
Yes,
when you are
exactly.
wrong.
How much do you make when you're right, and how much can you potentially lose if you're wrong? Like we know that Nvidia, chances are it's not going to drop to zero, right? And then, but then to the moon it can go. We have no idea how big the company can fly up. So the same thing as Tesla. People who bet Tesla back then is also a form of correct compensated risk. But let me give you a negative example of one that I don't think is good. So for example, we all heard of the company Coke, right? Coca-Cola, right? So we know that they are solid dividend company. They pay like 2 to 4% a year, around there. Dividend keeps going up. But then if you look at their historical past performance, right, it's such a big company. It's very sluggish already. It's like they are earning. I think their performance was like 3 to 4% a year, gain. So let's say it comes to a decision whether you want to invest in Coke or whether you want to invest in the S&P 500 totally, right? It makes more sense to, in my opinion, put more money to S&P than to just one individual stock, right? Because Coke is just one individual company that appreciates like only at 3 to 5 to 6% a year. However, you have the S&P that can go 7, 9, 10, even 20% or higher. So some investments, the risk makes sense, like Nvidia, some doesn't.
So Eric and Kelvin, you all agree with this or not? Or have any clarifying questions?
Oh, okay. Just for Sean, your
Yep.
holdings for US and China, are there individual holdings or are there like ETFs?
Okay, so for China, I'm forced to do some individual holdings lah, especially for the Chinese banks ma. You can't, there's no banking index. So I buy around half of my Chinese exposure is banks. The other half is like the index, Hong Kong Tracker Index, the 2823 that has multi in it, CATL. And then basically Hong Kong Tech that has Chiking's favorite stock, Alibaba, that has that also there lah. Then for my US stocks, right, it's mainly ETFs lah, VOO, BTI, stocks like that. I don't really hold any specific individual US stock.
Yeah, the reason I'm asking is because like when I compare, not let's say Alibaba lah, not to say
Yeah.
Alibaba is a bad stock. And
Right.
it's not, I'm trying to be politically correct. I do think it's a
Right.
good stock. But
Right.
when I see is the compensated risk kind of thing, right? When I
Yeah.
see, okay, should I invest in Alibaba, which has that political risk on top of
Right.
it, versus something like, let's say, Amazon, which maybe not Amazon, or maybe something
Right.
more, that's faster growing, like maybe Nvidia, let's say. There's a much bigger potential of going up. Even like the government is doing a lot of policy to help Nvidia in a way.
Right.
So like, would it make sense to not hold Alibaba at all versus hold more and put the allocation more into like other US stocks which have more growth?
Well, okay, this
Potential,
one is
yeah.
really this is really tough because we don't know the future, right? And we don't know your individual risk appetite, right? So this one is really based on what you feel, what you want, and the valuations, right? For example, I think we can all say that at least for Alibaba, it is quite depressed. They have a lot of free cash on their books. The P ratio for tech company, in a sorts, is quite okay. However, Amazon, like the rest of the big tech, is quite bullish. So this one, I can't really say whether to buy or sell it, because it's like, as I buy growth stocks as well, right? Through the ETF VUG. So in a sense, I'm also quite bullish Amazon. So I think it all depends on your asset allocation. Like if you ask me, and put a gun to my head, ask me to buy Alibaba, right? I don't think you'll go beyond 2 to 3% max.
Okay.
So what's the thesis behind China banks? Are you buying into like value, or do you see this real estate, crash in China is a nothing burger? So what's the thought process there?
Okay, so when I got into Chinese banks, it was exactly my so-called my compensated risk play, right? So I got it when Chinese banks were yielding 10 to 11% yield. I got it quite low. So right now they're up like 30%. So at that point of time, right, I really had a discussion with myself. So I had to think. I had to think that, okay, what are the odds of Chinese banks crashing all the way to zero? Because we hear all the fear stories that it is one big black box. You don't know what's going on inside, right? Which can be quite true lah. They're not going to tell you the level, the quality of the loans. But then you also think about it, right? Okay, all the local Chinese governments, they're earning their revenue more or less from the state-owned banks as well. A big part of it, right? So if that collapses, right, China itself will collapse. And if China itself collapses, right, is a systemic bank, the rest of the world will get impacted or even collapse as well. So the risk of the Chinese government not coming in is actually quite low. So at that point, I'm like, okay, I'm getting 9 to 11% dividend, right? And I look at the Chinese bank chart, it's just like a sine wave, right? If you look carefully, right, it's just like a sine wave. It goes up, goes down. Over the last 20 years, you can see that it doesn't even move at all, right? Okay, so worst case scenario, barring a collapse, I just earn 9 to 11% dividends,
But
right?
in terms of the number dividends that they pay out, right? Have
Right.
they adjusted it down, or still continuously pay and even increasing their dividends?
Okay, for now it is. I mean, for now it's they maintain it lah. I think they just want to get investors into the banks So
Yeah.
maybe for now. And right now, as we speak, right, I don't think Chinese banks is a good buy. When I
Really.
bought it back then, is a good buy. Now it's not a good buy because bond yields are going down, and then the bank's net interest margin, the loaning out, is under pressure. Right now, they're keeping it, how do I say, steady, but then you don't know whether the government wants to ease the economy even more, so it could go down, and that could affect the stock price. So it's about timing as well. When I bought it at 9 to 11% dividends, it was a good buy. But now it's only 6 to 7%. I think it's a horrible buy. It's a dangerous buy.
And has that been, a situation where the banks just give, like they just go forgive the loans as instructed by the governments? Has it happened recently? Because in the past, I think it happened, right? Yeah.
Yeah, I mean, I'm not exactly sure. It can always happen. So as I said, when you want to make these kind of investments in so-called more opaque markets, right, you need to make sure that you're getting a good deal, and you need to make sure that your downside potential of a downside collapse is not really there.
Okay. Podcast member Chicken also owned a Chinese bank before, but he sold out. So
Yeah, he told me he sold out everything.
So Sean, how do you see like Singapore banks, like China banks? You given your take, then how
Kena flame, I'll kena flame ni, walao.
will gonna
No, I think after what I'm gonna see, I kena flame. Okay, so Singapore banks, right? I think I think the rise from then to now is justified, right? I think the rise from then to now is justified. I hold OCBC as well, but the issue now is that the rise has been too quick, and we do not know whether it's sustainable, right? I mean, we have not seen a scenario where Singapore banks have gained 25 to 35% in a single year, right? And that lifted up the entire STI index. I think the biggest risk is, I think, is interest rates suddenly dropping from a kind of event that we don't expect. And then that could really send Singapore banks plunging, because historically, I don't think Singapore banks, their valuation has been so high before. So I mean, there are some black swan events that could come that could suddenly force the Federal Reserve to lower rates, and that could impact Singapore banks lah. I think whoever bought in the past made a very good decision, right? Because Singapore is going to be the hub, especially when US and China are fighting. But then going forward at these valuations, I don't know, man. I mean, I'm personally not adding more Singapore banks.
So when you say valuations, right,
Right.
you're talking about the book ratio
Yeah,
or
like price to book, that kind of thing. Historically, it's quite high. Yeah, I mean, some banks are more has a higher PB book lah, like DBS compared to OCBC or UOB. So I think this one you really need to dig into the financials lah.
because I'm a DBS investor lah.
Okay.
So they kind of traded at a premium for quite a while,
Right.
like 1.3 to 1.6, that kind of range lah. Whereas I think UOB and OCBC, they are a bit lower, like 1.1 to about 1.3. But definitely most of the banks, they trade at a premium for the past few years, okay,
Right.
because of the high interest. So because you're talking about valuation, because
Right.
I know that the banks, their earnings have been
Rising.
creeping up, have been rising. So actually in tandem with that, the share price also going up.
Right.
So the ratio itself is not like significantly much higher.
Right.
So I think is your valuation risk more towards like you don't see the ability for them to sustain this kind of earnings, like this growth, you don't think is sustainable?
Personally, I think the growth, we, I think we have hit more of the higher end of the range already, and there's more downsides than upsides. Okay, I think one reason why the Singapore banks continued rising, right, is because no one thought that the Federal Reserve, they'll continue staying higher for longer. Like this year, I think they're going to cut zero to one time, right? If we get two cuts, it's a miracle already. So that means, right, and rates are not going up. They're already staying there. That means unless Singapore banks somehow can churn out more loans to people, right? Like more people buy houses, more people open businesses, or they take personal loans, or I don't know, like everyone gets one more credit card in their wallets, right? Trying to ask for earnings to continue to rocket up at the same trajectory, right? It's going to be a tough sell. It's going to be a tough sell.
Because from what I understand, I think DBS, the banks are generally particularly yes, theirs is powered quite a bit from the wealth management bit. I think the loans part is like a little bit stagnate, like
Right.
maybe decrease a little bit even. Yeah, so it's mostly the fees from their wealth management that is like increasing. So that also ties in the fact that we have more and more millionaire,
Right.
multi-millionaire, or even billionaire
Right.
coming up to Singapore to set up family office.
Mm.
So the thing is, we wonder if the inflow of
Right.
the ultra rich will continue.
That's the thing, because I think it all depends on economic stability, right? Because right now we have not had a recession, everything seems to be churning, and how do I say? That's why we can see money or the capital flowing to Singapore. But
Mm,
if a recession happens, right? For example, right? I
mm,
think the big question is you have to ask is, will it affect the wealthy coming to Singapore, or will they scale back? Because it could be a domino effect. It's not just local Singaporeans say, F it, I'm not going to buy a house, or I'm not going to spend my credit card. It could be the wealthy also scaling back. So I think there could be a scenario where, one domino will strike the other. And I'm not particularly an expert on the banks, but for my feel, right, for my gut feel, right, at this point, right, I I I think it's too much of a risk for me personally, lah.
For Sean, it's always that things are crashing down by gold, hedge your portfolio.
Diversified
Yeah,
portfolio,
but
diversified
but yeah, but I'm observing the rich, right? You know, the rich in this group, right?
right.
They are not stopping from keep buying the next property. So just observe them. I think banks is continue to make money, man.
Yeah, of course, of course. The more, I see so much, lender condo sales going on.
Yeah.
Ah,
Crazy. Like the recent one, Ori condo also. I think it's like you look at the news, only open a few days, also close to sold out already.
no, for me, the property, I don't know lah. People buying 99-year leasehold, the thousands per square foot, when next door is
Yeah.
like a freehold, is like, I don't know, 10%, 20% cheaper. I've heard of stories like that lah. That really makes
Yeah.
you wonder a bit lah.
Yeah. Also, like influx of rich people. I want to switch gear a bit. Just want to cover, the hot topic because recently Trump, became the president, right?
Right.
And then just on the day one, executive order after executive order keep on coming, right? So it seems that now he really have the mandate and do, a lot of changes.
Right.
And the words tariff keeps coming up, but sometimes they say, oh, no more, not as serious. They market chung a bit. So
Right.
how do you see this space? Like, do you really analyze the politics between US and China, analyze all these tariff to make your, allocations decisions?
Well,
Yeah.
I think you have to, in a certain case, like whether Trump comes out with a tariff or not. I'm quite certain he'll come out with a tariff. I'm just not certain of the percentage, right? I mean, right now they say 2.5% scale up all the way to 20% or whatever lah. So I think when it comes to the tariff, right, it can really go either way. And for me, this makes the bullish case stronger as well, right? Okay, so what do I mean, right? So let's say Trump imposes a tariff on the world. Let's say 10%, 隆重, everyone kena, right? Everyone to tariff from Singapore all the way to Saudi Arabia. All right. So what does that mean? That means your exports to the US, chances are in aggregate it'll drop down lah. Less of your goods flowing. So individual countries around the world, they'll start earning less. They'll start earning less. Then from the US consumers, they will start spending more, because right now there's a 10% tariff, and not all US production has caught up to boost their own domestic demand, right? I mean, you all heard the meme, right? 90% of Walmart is made in China. So everyone will be paying for more. So all these tariffs, if they pay, it goes to the government. And US government spending is not efficient. I'm gonna be very polite about it. It's not efficient. They waste a lot of money doing a lot of stupid things. And what happens at the end of the day, to put it very simply, the money flows to the people on the top, and the people of the top, they buy assets. So that's one way to see it. And that's what happens if Trump wins his tariff war. That's if he wins the tariff war, right? Everyone, they all bow down, they all roll over and let US have its way. Now, but on the other perspective, what if the world decides to resist the tariff war? You decide to say, no, we're not going to play your game. You're not going to jump over the hoop like a tiger in a circus, right? We are going to set up our own barriers. So the same thing happens, right? That means your own local consumers will get hurt. And in order to make your country survive, governments around the world, right, especially China, they have no choice but to stimulate. And when you stimulate, how do I say, everyone starts spending again. And then we live in this kind of capitalistic society, right? That spending once again flows all the way to the top, and people on the top, they buy assets. So this, I mean, essentially it's like that. Essentially it's like that. This is the world we live in. And because of that, right, no matter what door Trump chooses, right, we might get a short-term shock when markets, collapse, right? But overall, he's going to make the inflation situation worse. He's going to make inequality worse. He's going to make the wealth transfer even worse. So it depends on who hurts more initially, lah. But at the end of the day, right, you still want to be, at least in my opinion, I'm still long assets, these assets at the end of the day. Why I still have some cash is, you have to service the mortgage, as well as if the market suddenly collapses, you can buy in. But this tariff war, I'm strangely bullish about it, lah.
Wow, tariff can be bullish. What the case? Yeah, Kevin or Eric?
Any predictions for 2025? Like
Walao.
how many percent will go up?
I give it a 30% of a big market crash from the shock of a tariff. And if everything goes haywire, right? Like for example, China put up their own tariff to fight against the US, then suddenly a friction of goods, right? Then I could see the market have a big correction down. But I don't think I'm going to change my portfolio allocation lah. Still 30% US, 20% China, 20% gold, then the rest, the world index lah. I think for me it's something that I can buy and sleep at night lah. I think that's most important lah.
30%. Boon Tee, you have anything to say about that?
Which part? 30.
30% drop. You are
Oh,
bullish, right, for
yeah.
S&P?
I mean, it could happen, right? Because we always say, like, just how Sean shared that, let's say global or US average is about what, 8 to 12%,
Yeah,
right? But if you look at historical data, the market returns rarely stay within this between, let's say, 5% to 15%. You always go, short below this range, meaning we get something like negative 20%. Then next year we get like positive 30%. So average out is true, but any given year, right, could be, having a big drawdown, right?
I mean,
and
我们已经两年 20% 了嘞. That's the thing. We already
Yeah.
had 22 years of
Oh
20%.
no, this year, scary.
This time is different.
I really die. Time to buy gold.
So I think Sean having what 20% in China, still bullish on China lah. So China can go green dragon.
Wow, that one tough leh. I mean, asking people to buy China stocks now was tough. That time was a no-brainer. Now it's tough. Now, if you get to China stocks, just prepare for a wild ride lah. Because the China government right now, right, realistically, they are talking more than they are doing, right? They are right now talking a very big talk there. I hope they can really back it up with stimulus lah. And if they do stimulus, wow, the big winner is the person not here today.
Yeah, that's true. Okay. Any other questions that we need to cover? Because if not, almost 1 hour already. Kevin,
Yeah, I think that's all.
Sean, any things that you want to share?
Nothing, man. I just think this year will be very exciting, and just hang on tight lah. The collapse might be here.
Wow. Buy go. Yeah, okay. Thank you so much, Sean, for coming to the channel. We hope that we don't see we hope that we will get you to the show again not too long in the future. And thanks for coming.
Hey, no problem. Just call me back when it collapses.
Okay, thank you. See you.
See you.
Bye.
Bye.